Good morning, everybody. Welcome to Wednesday, a busy day by the looks of things, the way markets are moving at the moment. Hope you're doing all right. Morning, Kay.
Morning, Ryan. Morning, everybody.
Still is here, but not here. He's doing all the back end stuff at the moment while Steve's off, so he might not be verbal this morning. So might just be you and me, mate.
All righty.
How's things? How are you getting on with this dollar move at the moment? Seems to be taking a few people by surprise.
Yeah, myself included. So I took it a little bit on the chin over the past day, really yesterday and this morning a bit as well. So yeah, I'm in my phase of a little brain reset. I didn't think things would go that far. But we'll have a look at things later, and I'll explain a little bit what's going on and what people may have missed on the price action in yields and stuff.
Yeah, cool. Right, so we'll get through some of the bits and pieces. There's not too. This is a nice part of the month where all the main central banks are on their blackout periods, and so there's no waffling of 15 Fed speakers a day, ECB speakers. I quite like it. It's nice and quiet.
Ryan, have you already started screen sharing, because we are still black?
No, I haven't yet, but I'll do that now. There we go. Just so you got something on your screen now. But yeah, I like this period. It's nice and quiet. We can do without all the squawkers for a bit. But that also reduces how much headline stuff we've got to go through. But let's start with China. The PBOC fixed the yuan at 7.1638, largely unchanged. I think it was 1668 yesterday. But there were stories out overnight that they'd been getting their state banks to dip into dollar yuan on both currencies, both the onshore CNY and the offshore CNH. So into both currencies there, and you can see quite a steep fall there for the dollar yuans. Obviously, they've had a little bit of help with what's going on in the dollar generally, but they, again, looking a bit opportunistic, hitting it while it's going the right way, gets them double bubble sort of thing, double money. So that's what they did in there. But they are also looking down areas again. The Wuhan area is apparently heading into lockdown after 18 cases were found yesterday. So still very much COVID zero policies in play. There's no chinks of light really in them turning that around. A lot of the markets since the Congress been looking at whether they are going to ease up. Absolutely not, as far as things stand now. So need to keep an eye on, again, if they start looking down some of the big manufacturing areas again, ports, that sort of thing. That's going to impact supply chains, growth, that sort of thing. But at the moment, they're ploughing ahead with zero COVID policy. In Japan, we've had a bit of discussion, or some in the press are raising the discussion about, has Japan announced their intervention to other countries. Yellen said yesterday that they hadn't been told about this intervention, but then there was a comment last night saying from Japan saying that they don't have to tell everyone what they're doing all the time. But the FX diplomat Kanda said that he's in touch with G7 countries and others every day, including talking about FX. And on top of that, we've had the usual waffle from all the Suzuki and everything. Nothing real of change there. They're carrying on looking at these excessive moves, fighting speculators, and so on and so on. While we're in Japan, we did get some inflation data overnight. Corporate services PPI came in at 2.1% as expected, but it was an increase over last month. That 2% last month is actually, I believe, a revision higher on the 1.9. 2.1 puts it back at, and I'll just show you that on the chart quickly, it puts it back at the prior high, although this chart hasn't updated, it seems. So we have been as high as 2.1% back in July. You can see it was coming off a bit, but that's now moved back higher. So inflation data there still on the up. Aussie there was some inflation data as well, very strong. It's quarterly numbers, but still quite strong. Quarter on quarter, beating expectations, matching the prior quarter at 1.8%. Year on year, 7.3% versus 6.1% prior. Again, beating expectations. But as I say, remember, this is a quarterly number. So if it was a monthly number, it may show a little bit of a shallower rise up, but that's still a hefty jump there. 120 basis points. Then they've got all their, a bit like the Bank of Canada and Stats can have a few other goes at trying to gauge inflation. All the numbers pretty much higher, bar this one, which just came in unchanged. So overall, that puts the pressure on the RBA, and the hike, 50 basis points, is definitely sealed in now into markets, and we're probably trading whether it's going to be 75s or 50s rather than 50s 25s at the moment. So inflation pressure still remains there. A couple of other numbers there from Japan you can see below there. Again, not doing too bad at all. Higher, 1.7, 2.4, leading index particularly, jumping there. So the data largely still going the right way for Japan, but they're still waiting on inflation to become sustained, and wages more so to become sustained, and that's the fly in their ointment at the moment as far as inflation goes. Over to the UK, Sunak, who was getting all his chess pieces on the board, all his cabinet. Hunt is going to remain as Chancellor. Now, the big news everyone's talking about at the moment is that this fiscal statement that was due on the 31st of October may not happen now. It may be delayed, and it may be delayed until after the Bank of England meeting. Obviously, Sunak, being ex-Chancellor himself, is going over everything that was in the original plan from Truss that got chopped up already. So we're probably going to need to expect further changes there. It may or may not come out 31st of October. That's going to change things up for the Bank of England, and what people thinking may come from that, because as Bank of England members have said, they need to know what's in this fiscal statement to then decide on policy. Now, they are all in close contact. They are naturally, the Treasury sets the tone for the Bank of England in terms of procedures. So they are in close contact with each other. So they're going to be talking about this all the way through. The difference for us is that if this statement comes after the Bank of England may be acting on it, and we won't know exactly what they're acting on, if you get my drift. So it does put a bit of uncertainty into the trade at the moment, and rate hike expectations. Let me just have a quick look what we're looking at. Bank of England. So I wouldn't say it's 50-50, but a 75 pip hike at the moment is currently being priced as a 59.5% probability, and a 100 pip hike is the balance, 40.5% probability. So it's a bit in the balance what they're going to do, whether it's 75 or 100 basis points at the moment. Perhaps if they go the 100, we need to hear what the explanation is with it as to why they've gone so big, and if they blame it on the fiscal stuff to come, we know there's going to be some stuff in there that we need to look at in detail. Now, today is Wednesday. Sunak's in the hot seat. It is PMQs. It's going to be his first PMQs. That's Prime Minister's question time. That happens from 11 o'clock GMT. I'll put the link in the chat room for all our roomies. So if you want to have a look at that and see how he's going to go down facing the opposition, it's always good for a bit of a soap opera at the best of times. But we'll get an idea how he's going to set himself out in terms of fighting the opposition. Quick look at the data from yesterday, because pretty much the data has kicked off what we're seeing in markets at the moment. So it started with the house. We saw a bit of weakness coming into the FHFA and the Case-Shiller house price numbers there. As you can see, month on month in the Case-Shiller down 1.3% on the composite. The 20 city number coming in down 1.6%. The FHFA on the month coming in at minus 0.7, another negative there. And the year-on-year numbers are just edging down, running pretty hot, but they're sliding as well. As you know, regulars of the Flow Show, this is the last piece of the puzzle for me to fall into place to say that the housing market is really on the cusp of a big downturn. When prices start going, that's really is the last domino. Not going to say everything's going to collapse, but we're at the start potentially of a trend lower in prices. That's going to bring everything down, and that's something the Fed's going to pay attention to. And that was followed up by the US consumer confidence taking a fairly decent dip there to 102.50. So not looking too good on the consumer side either. The one-year inflation expectations, however, rose back up to 7% versus 6.8 last month, and that 6.8 was down from 7% the month before. So a bit of a jump there in the inflation expectations. Now, we also got the Philly Fed non-manufacturing, which is never on the calendar. That came in soft as well across pretty much all the components, bar employment and wages. So again, a little bit of a inconsistency with what the Fed's wanting to see. Some things going their way in terms of a lower demand, with the headline numbers in the Philly services moving lower, but then we see some of the inflation pressures bouncing a bit and employment bouncing a bit. So they're still not there. So we're close at the moment to the Fed ticking all their boxes in what they want to do in slowing the economy. The housing market, we know, is gone or going and pretty much gone. We know there's now softness in services and manufacturing based on the PMIs and the regional surveys like the Philly Fed. Consumer confidence is on the flip as well. So everything is starting to head the way that the Fed are actively seeking. We're just waiting on inflation and jobs to follow suit. If we get those boxes ticked, then we can start thinking, where's the top? And then from that point, how long they're going to stay high, and then the pivoters can start making their case for when rates will start coming back to wherever they set their neutral level at. So that was pretty much a big batch of data coming out that was negative for the US, and it's come on top of what we had last week with the Fed whisperer Timmy Leaks coming out and lowering the case for rate hikes going into December. We've heard from Daly, we've heard a couple of other Fed members coming out and saying, yeah, maybe we're at the time where we need to start slowing. So it's all falling into place, and the market's getting that realization. And really, the only place you need to look at that is in yields. So I've been talking about the 2-year yield today, and what I'm looking for, as you know, I've been trying to trade basically the top of the dollar move. I was short in dollar yen for 144s. I was buying Aussie dollar down to 62s from 64.70, my entry way back the beginning of October. But even this move has surprised me. It's a bit too hard, too fast to say this is a definitive turn in the dollar, but the evidence is stacking up. But what we have to be careful of is that things don't go too far to the dovish side. And I'm speaking particularly just in as far as the Fed is concerned next week. None of the data so far says the Fed needs to turn around and say, oh no, we're stopping rates now and we're going to be looking to cut them in 6 months' time. But the market, the pivoters are having their day in the sun again. They're sending the dollar lower, they're sending yields lower. If those numbers get to an extreme dovish case into the Fed, then I'm going to be looking for potential reversal trade, because I don't see the Fed coming out and giving in to the pivoters. So something like the 2-year yield here, pretty much reflective of where rates are likely to get to in the ceiling, you know, some 4.5%, 5%. So at 4.44, we're bang in the zone. If that number starts getting down to the low, maybe the 420s, even worse, into the Fed, that's going to signal we're going too extreme on the dovish side. And if the dollar has followed suit with that, then there's a big risk that the big price move will be bounce. But we'll talk about some of the other levels going on in a moment. Kay, what do you make of all the bits and pieces? Any headlines you want to add, or just get into what you see these moves doing?
Well, the one thing that I wanted to add is that yesterday I was saying that it's all red. Yesterday, really, the data were bad, or at least showing slowdowns in the US. And then you add on top that the earnings that came out late last night was weaker earnings from Google. Then you add on top a bit of Microsoft showing slowdown, and a couple of others as well. So everything fell into place yesterday, all of a sudden. And I think we've seen a fair bit of the medium, perhaps not the real longer terms, but the medium term players at least, who were I think very long dollars, have sold out a fair bit at least. And the short termers, they've already pivoted. I think they've already trying to play the short end. But what I make of all this is I'm going to show the comparison between the 2 and the 10-year a little bit later once you're done, because that's where actually the move comes from.
Well, do you do it now while you're talking about it, mate? Then people can get a
Sure.
Yeah.
If you
always flick back and forth. Let me stop that.
Yeah.
Just so people know what you're talking about. And I want to question you on that as well, because there's a bit of a disparity between 10s, 20s, and 30s.
Yeah. And I'll run through them. But first of all, we see the one that you showed. And before we even talk about rates, I'm straight away going to take a question here. Is from Karen, who asked if the yuan fix is tradable or worth trading. It comes conveniently on my lunch break. No, because we outside of China, or unless you are in China itself, but for us outside of China, we only trade CNH. So where it may become tradable is that PBOC tries to guide their fixing rates, because they have something called, what is it called again? The non-cyclical buffer or counter-cyclical buffer or something that they can to fix the onshore yuan at different levels from where we or from where the models would think that it has to be fixed. So it's tradable in the sense that they usually allow some 2.5%, or is it 2% or 2.25% on the onshore moves. But then when we see the CNH, like for instance, as long as they were keeping the dollar yuan fixings at or below 7, the dollar CNH had a bit of trouble to go above 7.10, 7.15, because you can speculate for as much only, right? And so I'm paying attention to this 2.5% yuan CNH, which is the offshore yuan. I'm paying attention to that as well, because if it goes above versus where they fix it, and that may hint at some sort of excessive speculation. So you can be bullish dollar CNH, for instance, but if you started to see like 20 cent, or I don't know what the cents are in China, but if you see like 20 big figures or more above the fixing, which we saw yesterday, it's a bit you should be a bit cautious. It's possible that they are going to come out with some comments or ask their submarines to go into the market. So in that sense, you just look at the correlation of the fixing versus where the models would think the fixing is, because it's based on a basket, and then where your CNH is trading, and you make your little comparisons on the back of all that. So that a quick word about this CNH thing. Okay.
Can I just add that quickly, mate?
Yeah.
Just from my point of view, there's two things that I monitor it for. Is it is it leading or is it lagging? Sometimes they fix it higher if they're playing a bit of catch up, and that means they're letting the weakness go if they keep moving their fixings higher. But if you get a period where they're keeping their fixes pretty stable, even while the currency is moving high or the one's weakening, then that gives you a little bit of a clue that perhaps they're not allowing it to go. And like Kay says, when it's gone 20 big figures above the fixing and they don't move that fixing up, and in fact they lowered the fix today over yesterday, that tends to say, okay, they're drawing a bit of a line in. And then on top of that, we got the sources news of banks stepping in. So it's they're either chasing the market or they're holding the market. And if you know which one they're doing at the time, then that's when it becomes potentially tradable.
Okay, thank you. Thanks, Ryan. So yeah, I'm just taking the move from here in the twos from the last dip, and then we see that we're still in a pretty much an uptrend channel here, which would only be broken if we start to get back below 415, 410, and it's gradually moving higher. So it might come in around this 420 in a bit. There's going to be big levels here, but I just want to show actually, and I should overlay the 10-year on there, but I don't know where I can see the curve on TradingView. I should look that up. So as Ryan was saying, we're hanging around this 440. There's a bit of more support around 435. So, and then moving over to the 10s, we've seen this same kind of channel, and we hit the top there of the channel around in the 430s, and then a sharp move lower. So this is about 30 BPs, right? So back onto the twos. So the difference between both is understandable, I would say, because the twos and the threes, they are pricing where the Fed wants to be. That is what we could say, like that's going to be closest to the terminal rate. So despite what we have seen in the Wall Street Journal, from Daly, from I don't know whether it was Evans or also who also said we may be starting pausing, and then Brainard as well, even a few days before. So despite those things like they might be slowing or pausing, these things should, in theory, unless US economic data really crap out. Now, this should, in theory, hold somewhere around there, because this is pricing a terminal or a pause rate or whatever, where the Fed may end up, right? So this is going to be less, or should at least be less impacted by what we are seeing this week and by expectations of, for instance, a recession, unless, as I said again, data really turns sour. But this should hang around here. So what the market is pricing is what is beyond when the Fed is reaching their target or their pause yields and whatever. So for as long as the economic data were holding up and there were no signs of pausing or whatever, the 10s, even the 30s, they were moving close to what terminal rates were going to be. The 20s even overshot, but I think that's a liquidity problem. So this is where the market is pricing the slowdown, and this is really because they look beyond what the Fed is going to do, and they say like, okay, but the Fed is going to go there. This is going to be painful. Now we are seeing in the data that it's starting to be painful. So let me kill my squawk. So it's starting to be painful. So this is where we are going to reprice on the longer end, not on the twos and the threes, but if you see, for instance, 5s and 7, the belly really got whacked lower. They also went, like, if you look at the 5, went to 4.5. We're trading around 420. The 7 went to 445. We're trading around 415. So this is where you are going to see the slowdown pricing. So the twos are going to be the one where you monitor or the expectations of a terminal Fed rate. So they are going to be repriced as well, because there's a lot going on, right, in the bond markets. But I'm going to spare you all the details, because otherwise we'd be on it for hours. But just for the simple thing, for the simple understanding of what's happening, the 2 and the 3 year, but especially the 2 year, are going to be the closest ones to where the market expects the Fed funds rate to end up. So even if the rest is pricing a slowdown, those things may just hang around here. Okay, we may see some corrections if we continue to see slow data, because of course the Fed funds is a short-term rate, and people will be pricing slowdowns and things like that. So we might go a little bit lower. But if Powell tells us on Monday, no, this is exactly the pain that has to be taken that I was talking about. We are not going to stop right now. This one should stick around here and perhaps even move back to where we expect the terminal rate will be. But this one is going to be then on the other side less impacted. You will see a move back up, and you probably will see a move back into dollars and stuff in the short term. But if the data in the US data, if they don't improve markedly, I think we may have seen the top here for a while, and the market will continue to price in. If the data continue to be weaker, this one I think is at risk, and the result of this is that the yield curve is moving more into inversion, because if this one continues to hang around in the 4.5, but this one starts to go below 4, and there's a support here around 3, just below, call it 395, 390 as a confirmation, and the yield curve goes more deeply into inversion. That is usually a very dollar negative setup. So I just wanted to explain why the short end is holding up seemingly despite the data, and why the longer end is more affected. Now, if you look at the 20s and 30s, that was your question, Ryan. The problem is, and I think that's a problem of liquidity. The 20s, for instance, we've seen a while back that since there was not enough yield yet on the 10s for the Japanese, that was really a while back. I think it was around, could have been May or so. No. Yeah, it was. Yeah, that's here around June. So we saw the 20s tick higher, where the 10s were correcting, and then we saw a bit of articles come out saying that the Japanese moved a little bit more into the 20s because they got more yield differential there versus the yen. But I do think the fact that 20s and 30s are going to be also very economic data dependent, but there's been a lot lengthening of maturities as well over the financial difficulties during the pandemic. So a lot of people moved in there as well. So they are, and since there is less liquidity overall than in the 10s, where the bulk of the liquidity is in the bond market, so they can move a little bit more, but and they are going to be quite data dependent. But don't be mistaken, those moves are big moves. We spoke about it with Stelios the other day, and if you see bonds moving by last Friday, we were trading at 434, and now we are trading at 402, 404, 405. Those are big moves. So there's a lot of money being shifted around there. So that a bit about when and where yields could be moving because we had a few questions in our chat room as well. All right, let me move over to what's been happening. If you allow me to, Ryan, I'm just going to have a quick look at some charts.
Yeah, go ahead. Gavin's just pointed it out. I've just seen on the headlines as well that the UK is likely to boot the fiscal plan to November 17th, which would have been usually when we get the autumn statement. So they're making it effectively the usual autumn statement, which now puts it after the Bank of England. So thanks, Gavin.
All right, thanks, Gavin. So yeah, we've been breaking up quite severely. There's a couple of factors there. Of course, it's we're ahead of the ECB. They're expected to raise rates, and then we saw the downturn in the US data. US data really catching up with what is happening over there. And as Ryan already pointed out, the housing market is starting to see effects. And now we are seeing, over the past couple of days, we are seeing really data starting to turn. So it's over to Powell to explain to us what really what their plans are, how they look at what's happening to the data. We've got PCE out on Friday. Is that correct? Let me quickly check.
Yeah, PCE on Friday. Yeah.
All right, so that's going to be an extra layer to add on before we get to the FOMC. I did not see that this one coming, and I did have well, I'm still in my long silver and stuff, but I must admit I had a bit of eye flaps on in the past 24 hours. So even though it didn't cost me a lot, because my discipline is such that when I'm wrong, and I don't omit to cut. But on the euro dollar, this one now around 99.50, it's broken. We've also broken a bit of this trend line as well. There is a possibility, depending on what the ECB says, to go and test the 101, which could still, in the bigger scheme of things, be a bear flag in some way. But forces to admit that the market is now trading worse US data, and they may be really trading it until Powell tells us. So we've got to be a bit careful. We've also end of month. This month, I'm going to stick my neck out. This month, we are seeing a revival of the equity markets, which may lead to more dollar selling into month end. So before even the Fed comes, there could be more dollar selling coming. And I would suspect that on the basis of the combination of the articles, the comments, and the data. On a setback towards those levels, we may see more dollar sellers, euro buyers coming in. The other big one, of course, is the sterling. Yesterday we broken through the triangle. This 113.25, a bit of a traffic light. I tried to play against the 114, but that exploded in my face, so I took a bit of loss there as well. Yeah, the Sunak rebound, and also what is happening and what we can see on the price action as well, and that's just an in between brackets. What's happening is that we've seen a revival of the weakest. As you can see, the sterling was the one that got hammered really hard during the fiscal woes, and even before the data were not really supportive of the sterling. But then we had the change of the guard, we had the change of the fiscal plan, and we had Rishi Sunak, who is more positive for the sterling, as Ryan already mentioned really a number of times. So since the sterling was one of the weakest currencies, it had the most room to correct, and that's what happened. And the market really, I I don't know whether it got taken by surprise, but at least there's a lot of sterling being bought back over the course of those past 24 hours, 36 hours. So we've broken through here. I don't want to do the exercise of putting it on top here, because I think this is a panic low. I don't really even take it into consideration. For me, the big one, as I've been saying here, was the low 109s. Well, at that one, then is 500 points. We could go into the 118s, and that is very possible. But I think there's here is another one waiting for us, and that's around the bigger pivot level. I've always been respecting this 117.60 in the cable, and if cable really has more legs, it doesn't seem to be giving back much more, and this could be a target into the BOE. Who knows? Especially if the market's really on the 1% increase train. I don't know whether it's justified 1%, but it could be seen the inflation, right? The data would not support it, in my opinion, but the CPI does. So keep an eye on that one. First support 115.5, then the psychological 115 here as well. So we've got already a bit of support to get back through if ever this would fail, and then goes back to 115 through, if it ever would go back to through 115 in the upcoming session or sessions. Then we are looking again at 114, and now I think the 113.25 is going to be a big traffic light, a big crossroad for the cable in the shorter term. So we've got about 400 points here, and looking at the speed of sterling moves, why not? You know, euro sterling also. It respected the triangle for a while, but we've broken through it this morning. I would be a bit cautious for more downside, because we still got the euro in this pair, and ECB is before the Bank of England. So I wouldn't exclude like some sort of a bit of a rebound perhaps. But if the sterling continues, we could go back down to 86.15. And if really the market is short and feeling pain, why not even just below 86? But in my playbook, this may hold. I'm just trying it for a very short-term play. I'm not putting in a lot of risk in there. It's actually very small and very tight. But if we start to move ranges, also respect again the 87.25.45 and the trend line. So we've got a bit of a looking like a bit of a sideways setup here for until Bank of England. And now, as Ryan said, we are going to have to wait a lot more for the budget. So that's going to be a long wait. I don't know what the hint may be, to be honest, by the Bank of England as compared to the budget to come. Do you have any idea at all, Ryan?
I think they were worried about if they went too much with fiscal spending, they were going to have to raise rates higher than expected. So I think if that's reined in, I think if we get a 75 pip hike rather than 100, I think that's going to indicate that they're happy with what's coming from Sunak. It's not going to be, negative in terms of how Truss was. But does that make it pound positive because we're not going to go so far in the hole, or does it make it pound negative because we've not hiked as much as maybe the market expects? So, yeah, I think for the longer term, the 75 pip hike puts them firmly in just rates on the data rather than on the fiscal stuff.
Yeah, okay. I mean, it's a bit cloudy in my mind to try and find the hint for the budget in the BOE. If Kwarteng and Truss fiscal plan would have come through, I think that would have trapped them and they could not raise rates too much. But if the fiscal plan is more austere, that might give them more room to hike, right? Because the Treasury won't be needing as much funding as it would have been under Truss Kwarteng, right?
Yeah, but then you could look at the other side that it would restrict activity a bit. You know, austerity means cutbacks in public
Yeah, I know.
spending.
It's
So
a,
yeah, it's a messy one to try and
yeah,
sift through.
and as usual, a lot of the political decisions around government budgets is really a double-edged sword. You can really look at it from each side of the coin and find a reason why it should go up or a reason why it should go down. Really,
Yeah.
I've just this one, and we can even put it down here. Or perhaps not. This one, I don't know whether it's going to have a lot to do, but it's a bit of a reversal of this triangle, a mirror image, and the trend line, the upper trend line comes in at the 170.5, 60, where the top was today. So I'm going to keep an eye on it, but am I going to trade it? I don't know. I mean, it's a bit tough right now, ahead of the Bank of Japan and ahead of the Bank of England to go and jump into sterling yen for a really short term with very low risk. You could try to play it and put a stop just above, but looking at the volatility of this pair, it's a bit of a hard one to just put like a 20-30 pips stop on there, which is just basically 5-7 points in cable and 5-7 points in dollar yen, and we're already there. Okay. Okie dokie. One last thing is Euromex. You know, I'm really watching this very closely. We're in the zone, and so I added just a tad onto my positions. And the last one, for those who follow emerging markets, this channel in dollar rand that I spoke about, which had been respected, has broken. So that's another really warning sign, I think, for the dollar. It has broken, and similar but to a lesser extent happened in DollarMex. Ryan, with that, we are going to have a look at what the Bank of Canada may do.
Yeah.
Are you taking the charts, or am I keeping
Yeah,
them?
I'll take them for just quickly because
Sure.
first things first. I need to tell everyone what Stell's getting up to while he's really busy. He's in an arcade at the moment with his kids, as you can see there. Very noisy, very loud. He sent me that on Skype. I said I'm going to have to grass him up on the Flow Show and just let everyone know where he's at. So he's enjoying himself there in an arcade while we're all working hard.
Yeah, but it does have the ForexAnalytix chat room up. That is some dedication, right?
Yeah, and that's actually one of our devs next to him as well. So yeah, they are working hard there, despite what that picture may infer. Yeah, I want to talk about the BOC, but I just want to touch very quickly back on the yield situation, just so you can match it up to what we're talking about yields in terms of the Fed. So this is the last dot plot. So when we're talking about 2-year yields, you can see, you know, that's the dates at the bottom there. So when we're talking about 2-year yields, it's where the 2-year yields are reflecting this area here, basically, maybe even down to there. So that's, as you can see, we're up for next year. Let's look at next year. We're up in the 4.25 to 5% range. So that's where the ceiling is. So 2 years in around that area, we're looking okay. What the longer term yields are pricing, the 5s, the 10s, the 20s, is what happens over this period. That's what we're pricing. This is the uncertain area. You know, what happens at the next projections if the Fed, you know, matches what we see here and moves and keeps it here, and then maybe here. So all these dots that we see lower down move up into these boxes. That's going to change the course of the 5s, the 10s, maybe even out to the 20s, because then the market is saying, well, rates are going to stay up here for longer, rather than see this quick move back down to what we assume is their neutral area, probably around 2.5–3%. So that's what we're seeing now in these yield moves on the back of the data. So we may see some extreme pricing of the further yield, so the 10s, 20s, that sort of thing, because they're all trying to guess what the rate's going to be out here. It's only if this short-term changes around this area here, that's when we're going to get bigger moves in the dollar, because this is where the pivoters are trying to trade at the moment. They're trying to trade this area all around here. Where's the Fed going to turn? And if they start thinking the Fed's going to turn around here in 2023, that's when I think they're going to be wrong, because the Fed are going to be looking to keep rates up. So when you're looking at the yields, if you want to match it off against what the Fed's doing, you can look at the dot plot and see what's expected there. So I just wanted to touch on that quickly, and look at that. I made a nice mess of that picture completely. So anyone looking back on that now won't know what's going on in that one. Let's leave that. So yeah, we've got the BOC today, which is the first of our central banks this week, the big central banks. So what's expected? It's running at an 84% probability that they hike by 75 pips. 50 is the other one being priced, so it's the 75-50 game, not the 75-100 game. We do have the monetary policy report with this one, so it's going to be the press conference, projections, all that sort of stuff. So we will actually get to hear what they've got to say about things. Now, at the last meeting, they were pretty much all about inflation. They still see inflation sitting high. That's their game at the moment. Until they see that significantly coming lower, they're going to stay on their hike path. The last CPI reading pretty much followed what we saw in the US. We saw the core going up, and that rose to 6% from 5.8%. But the headline went the other way. You dropped to 6.9 from 7% prior. So a bit of a similar situation to the US, but none of the numbers signal that they're going to change anything. So 75 pips is what expected. I think that's probably going to be about bang on. Again, we're going to be listening out for where the potential ceiling on rates is. Are they going to indicate a slowdown in the pace of hikes? Will they want to front run the Fed? Will they have had any inside information from the Fed about slowing down? So if we get something like they're going to go 75 at this meeting and maybe then bring down the next meeting at 50, maybe even less, then we can probably narrow it down that the Fed are probably going to do the same. As far as dollar CAD goes, it's really moving around based on what the dollar's doing, what US yields are doing, more so than what is happening in Canada and what the expectations are for the BOC. So I'd be a bit cautious here over some of these moves. If we do get a less hawkish Bank of Canada, you may want to look at that if this dollar move, US dollar move, is going to continue being weaker, any bounce in dollar CAD might be a decent sell opportunity. Other than that, if they stick to the party line, I don't know if we get that much of a move again in the Canadian dollar. But as I say, it depends on what the message comes in after. What do you reckon for this one, Kay?
I haven't been really trading dollar CAD for a while, so I'm going to keep an eye on the crosses. To be fair, if they are half dovish, and we still got ECB to come, I think EuroCAD could take a bit of a dive. If they are hawkish, and we are seeing right now, but of course that's a punt. It may be worth having some Canada yen perhaps in the books. It all depends on how the Bank of Canada is going to spin this. There were some what's his name? Steve McLean. We call him Steve. Steve McLean said that they're perhaps not ready to stop, but the market was trying to price a little bit of a stoppage. And I've read some articles saying that, or some strategies saying that Canada is in a spot of bother with their housing market as well, and they are relatively bearish on the Canadian dollar. Actually, the local banks. So yeah, it all depends, because I haven't seen really the data deteriorate much in Canada, or enough in Canada to say Canadian dollar is going to weaken. But you also have a bit of the proximity to the US dollar, right? And so if you look at the American bloc, what I was saying earlier, it has weakened if you look at stuff like Euromex and MX yen and stuff, for instance. So the Canada may undergo the same thing if the Bank of Canada is a bit slower or less hawkish than what the market expects. But I'd rather trade crosses than dollar Canada, to be honest, right now.
Yeah, cool, mate. Understood. But did you want to have any look at anything else quickly before we call it a day?
Well, if the people want to look at something, maybe have a look on the S&P.
Yeah, have a quick look at S&P. I was going to have a quick look at Aussie dollar as well. Again, as we go.
Oils maybe not. They are less of the subject right now.
Yeah. So the S&P. Let's have a look.
Yeah, I've just seen Scott's comment. The BOC has to keep pace with the Fed, and it's a bit the same in Mexico as well. But that's where the market could really start to move if they start to diverge from what the Fed is doing, right? So
yeah,
that's where trading opportunities can all of a sudden arise.
Yeah. Right. So looking at the S&P, I mean, I still struggle with this, because I really don't understand how the US barreling towards a recession sees stocks higher. It still just doesn't compute. But this is the world we're living in at the moment, where bad is good for stocks and good is bad for stocks. So I still struggle with that narrative, but the market's going to do what market's going to do, and we are into the 38s now. I know Stel and a lot of the other guys have got potential targets at 39, where they're going to start shorting or looking for shorts. So I think that's going to be an extreme level. They've got a bit of a confluence of the moving averages coming in around at that 39 level. So technically, it is going to be a decent level to look at. Certainly, I think if we get up to that sort of level today, which will obviously be a big move, I think that'll be a decent stretch point to have a look at for potential shorts into that. But how far can it go? This is one area where the market may get too extremely dovish going into the Fed next week, and it's going to get a slap. So certainly, if we get above 39s, even higher, it's going to get a lot of people itching for a short on what Powell will turn around. And that's the point I want to make. It doesn't matter what the longer term picture is for the Fed. To one aspect, we spoke about that with the yield situation. The shorter term aspect is important. Where is the market leaning going into the Fed? Because if you know that, you know where the big price risk is. So if the market is leaning very dovish and the Fed are dovish, then perhaps there's very little move left in, because that's the way the market's been effectively pricing it in the short term. If the market's dovish going in and the Fed isn't dovish, they stay hawkish, then you know that the big price move is going to be the opposite of what we've been seeing on that dovish move. And that can switch day to day. We could get into next week and everyone's more hawkish again. And then you know that the price risk is if they're dovish. So knowing exactly the short-term sentiment, at least going into something like the Fed, that's important to know what happens when the announcement comes out for that short-term move. And then from that, you can look at the longer-term picture. That's S&P. Yeah.
Ryan, yeah, just Stel is saying that his stream laptop is about to die, so we should wrap it up if we don't want to lose anything for the week.
Okay, right. Well, let's call that day then before we go off air completely. We can catch up with everything tomorrow. As always, thank you very much for coming to the Flow Show. Wish you good luck today. Stay careful in this volatile move. Don't be thinking that it's the start of a massive trend. It may be, but it also may not be. It's been hard and sharp. Bit of volatility still in there. We can easily do a bit of a reversal on some of these moves on another bit of data. Thanks to Kay. Thanks to Stel in the arcade. Hopefully he's not spending too much money on the slot machines. We shall see you all tomorrow. Have a great day, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.